So I haven't been sleeping well recently, and I don't know why. This whole retired financial advisor thing is, I guess, starting to settle in, starting to have some realizations about the world, the life, a whole bit. So I end up thinking about stocks. I think about markets, performance, how's my portfolios doing at this point. And right now I'm pretty evenly split between crypto and stocks. Of course, the crypto is outperforming the stocks by a major amount, which, everything goes up, everything goes down. What starts will eventually end at some point. I get that. And so it's just more risk managing around the crypto side of it, trying to anticipate the volatility that will come, and I know it will come. But I was looking at my stock portfolio and looking back at some of the different trades I've made and where I've had success and where I haven't. And what I've realized is that there are certain companies I've done well in, certain sectors like financial sector, industrial, energy is starting to perform, and metals. So I'm playing that via the ETF route, and those are doing pretty well. They're not like up 10% a day like Cardano is on the crypto side, or like Bitcoin or Ethereum. But you know what? It's a different beast, and it's a different animal, and there's a different beta level on the crypto side versus the stock side. And so I take that into account, and that's when I'm measuring that risk side of my portfolio. But today, a couple things I was looking at is like, I really want to get my stock portfolio going better. So I'm looking back at some of the trades that I've done in the past couple months or so, and which ones I've had great success with. So one of them was Playboy. PLBY was the symbol. I first got into that when I read or listened to a research report on it, about how the company had been bought up by a private equity fund. It's no longer the magazine anymore. It's all online. And what they did was they went in, and after Hugh Hefner died, they went in and renegotiated all their royalty deals, so they would make more money, which makes them more profitable. They stripped away the dying magazine side of the business and went strictly online. And then they went, they're building and expanding their, goods, sort of like sweatpants and shirts. It's like so crazy when you see a family. I'm like here on the Panhandle of Florida, and during spring break, you see this family. It's a father, mid probably 40s, and then a wife, and she's probably a year or two behind him in age, and then their daughters. And one of the daughters is, personality, very studious like, and then you have the other daughter who's wearing a big old bunny rabbit t-shirt on her crop cut, the whole bit. And I'm like, how'd that go down this morning, right? But what it tells me is that brand is starting to gain momentum again. And so I bought into that, I think it was over a month ago. It was just after April 1st, and killed it. Like, had a great trade out of it, made a lot of money, was sort of blown away by it, and then sold it. It pulled back. I bought it again here recently, and it ran up, but I got stopped out because I was running my stops at about 5% below a trailing stop. So it reversed, and I came out with a couple percent gain in it, but nothing like I was hoping, like the previous one. And it's never like the same as the first one, right? What you anticipated to be the first time, what it was the first time. The second time you're you're always disappointed. So in that sense, I was disappointed, but it is a position I am looking at again because I see it building a base over the last couple weeks, and I'm like, well, maybe this base will make another move back to its highs again. And so I'm looking at that. That's one I'm looking at. So another one I have been looking at is Patterson Utility Energy Inc. Trades around, I think, $8 or so. It has a tail of about, this is in the last 720 days, a high of 1879. So from here it'd be 133% gain on that. My trend is up, my intermediate trend is up, and it has in the last 720 days a 18.79 dollar high. So it's got a pretty ways to go, and with where the energy market is and energy volatility, so the OVX is something I follow to follow the energy volatility. And so as energy volatility goes down, usually you see a movement. You couple that with volume and how that's trading, and then trend, and if the trend, intermediate trend, so more than 3 weeks, is positive, so I use like a weekly 12 period moving average on that intermediate. It gives me that baseline, and as long as the stock or position is holding above that baseline, I'll continue to hold it. If it comes down to that baseline and bounces off, that's a nice entry point. So that's something I'm watching. I don't know much about this company. The symbol is PTEN. If you know anything about it, please write in the comments. Give me your take on it. It's one I'm watching. I haven't bought it, but it is one I'm watching, considering, because it's one, cheap. I can buy a lot of shares of it, and it can be a really nice trade. I'm not looking to be married to it for the rest of my life or anything. I'm just looking to make a good return out of it. And I think that's something, as you build your trading or investing philosophy, is what is a good return? What are you happy with? So like I got out of a option trade I made 40% on it, which was nice, and the dollar amount was great. I sort of look at things from a dollar amount, because I'm like, well, would this pay for my electric bill? Would this pay my mortgage? Would this pay my car payment? Would this pay for college tuition? Not the whole tuition, but a portion of it, kind of thing. So I think in dollar terms. So that's sort of how I'm thinking through some of these plays. But that's one that looks interesting. The trends are up. The momentum behind energy is picking up. It could be $2 out of it, $2 or $3, which would be great. And if you got the share count, that could be a nice payday. And so that's how I'm looking at it. But I will run my stops behind it. Once I buy it, if I buy it, I don't know if I will, but if I buy it, I'll put a 5% stop below where I bought it at. And as it moves up, I'll inch that stop up and trail it up, so that if it makes a move higher, and let's say it moved from $8, hypothetically from $8 to $10, and I put a 5% stop on it, and it started moving back down, and I got stopped out of it, I still have profit. Whereas if I leave my stop at below where my entry point was in it, then I lose 5%. Does that make sense? You picking up what I'm putting down? So that's how I'm thinking about as I enter these positions and move those stops up as the stock moves up. If it doesn't work within the first, say, 3 or 4 days, if I see it fumbling, I'll probably just get out of it, because it's not the trend that when I get into it, I identify that pivot, if it's pivot, and then it confirms that pivot with 3 days up, and I see higher lows and higher highs each day. So I see that trend being confirmed on a trade basis. Then that's where I'll want to enter. And for some reason, if that trend, that higher lows and higher highs trend breaks down, and I see it fumbling, I'm just gonna get out. I'm not gonna waste my time or my patience over it. And I'll just get out, and if I have maybe a small, 1% loss in it, so what? I'll make that up somewhere else. But it's that diligent way of creating, rules around your investment process, and these rules can be applied to the long-term investor, to the short-term investor, to the intermediate trade investor. But number one thing is just have some rules to live by, because your emotions will jack with you a lot. I mean, a whole lot. And you'll be like me on the decision I'm making today about Coinbase and my euphoria. I got into that. Check out my video on that on my channel if you want to hear about my blow up on that one. I've slowly gotten out of it. I've replaced that with a option contract that takes me out to June, in hopes that May 13th earnings are stellar and the stock takes off, and I'll recoup my losses in the stock position with the option position. So I didn't have to allocate as much to do that, which reduces my overall portfolio risk on my stock portfolio. So those are a couple companies I am looking at. There is one more, and this is just really a cheap pot stock. 4 as in the number, Front Ventures Corp. It trades at $1.33. The trend just recently the trade trend went up. The intermediate trend went up, and it's got a tail, or a 720-day period high of $2.05. That would be a 54% gain if it went from $1.33 to 205. I'd be stoked if I bought, say, 1,000 shares of it, which would not 1,000 shares. Yeah, it'd be like $1,300, right? So if I could get like 50 cents out of that, that would be $500 or so dollars or something like that. Let me just make sure my math is right on that. It's early. My coffee hasn't kicked in. So if I got it, it'd be $1,300. So maybe I go buy a chunk. One thing I'm not going to do is overextend beyond 6% full allocation to any one of these positions as I'm building my position in it. And the reason I top it at 6% is because I can recover from a 6%. I mean, if the stock went from 6% allocation to 0, I can recover out of a 6% position. But 10 gets really hard, 15 gets really hard, and 20, it kills you. That's a couple years. It's a big lucky trade kind of thing. And that's where you don't want to get is desperate. So I minimize my equity allocation to a max of 6% each position. I do that because I don't want to see big drawdowns like we saw in March. I run my stops anywhere on stocks between 4 and 7%, 6%. But typically I just start out at 5, and then I inch those up as the stock moves up. If a position doesn't move within the first 3 or 4 days and I don't see confirmation, and this is from a more of an intermediate trading point of view, I'll ride something until the trend is broken. The intermediate trend is broken. I'll take profits at the top of the trend. If I see a exponential move up, I'll trim my position. If my position goes from 6 to say 12 or 15%, I'll trim that position back to 6% to the original, so that when it does pull back, and it will, I don't lose all that profit. So I cap the profit, and Some of you will ask, well, what about taxes? Just pay them. Calculate them every quarter and how much you owe, and write a quarterly check to the IRS and pay your rent to live in this country. So just do it. Quit fussing about it. I mean, because at the end of the day, would you rather pay, if you had a trade and you made $1,000, or let's say you made $10,000 on a position, okay? You've held it for less than 12 months. So you got short-term capital gains. And let's say that your tax bracket is, I don't know, let's say you have to pay 30% taxes on that. You make $10,000, you pay $3,000, you keep $7,000. Okay. Or you could hold it, watch it go down, and you have a profit of $1,000. Okay? $7,000 or $1,000. And you haven't even paid taxes on the $1,000. Okay? What would you rather have? Just pay the taxes. Just get over it. It's a process. Make it mathematical. Make it mechanical. Get the emotions out of your investing. Just build a process. There you go. So those are my things. That's what I'm looking at today. Of course, none of this is advice. This is my ideas, purely educational. You need to do your homework and do your due diligence. Anyhow, please hit the subscribe button, hit the like button, support wherever this video lands. If it's on my channel or on Best of US, please support whoever's channel this lands on, because at the end of the day, this is about you. This is about you getting smarter about your investing and living loud.